Thank you all for joining us for our session, the 2021 Fiduciary Updates and Fiduciary Best Practices. Before we get started though, I just wanted to cover a couple of housekeeping items. Now we're certainly, what we're going to do is reserve some time at the end for Q&A, but if you have any questions that you want to ask throughout, you can use the Q&A button at the bottom of your screen. So you can submit those questions there if we're going through something and you need some specific clarification. We'll be sure to monitor that as closely as possible. But many of you logged in. I see a lot of familiar names, and I'm picturing your faces in my mind. But if we haven't met before, I'm Vanessa McElrath. I'm a wealth advisor and partner here in our wealth management group at ML&R. And I also have Julie Reinhardt with me, our retirement advisor. And I think if you haven't met me, you likely have met Julie. She is a jack of all trades, and she does a fabulous job working on the compliance and administration of all the plans that we work with. And so while we certainly wish we could be together in person, but I think we've all done these enough that we're just kind of rolling with it, at least for one more virtual session. But really the genesis of this is, we do like to put together kind of annual sessions to cover what's new, what are some different rules and regulations that have come online or maybe coming down the pike. But we also know that a lot of you wear a lot of different hats, and you play a variety of different roles in your respective companies and firms. And probably just one of the many roles that you play is as plan sponsor or administrator or fiduciary to your company's qualified retirement plan. So that's certainly a lot under normal circumstances. And then once you throw in a pandemic, a tight labor market, switching to virtual and remote, you guys have your plates more than full. There's certainly been a lot to digest this year and last. So that's really what prompted us to, again, put this session together. There's been a lot of changes that have either come about or are being discussed. So we wanted to cover that and talk about some of the fiduciary changes, regulatory changes, but then it's also a good idea, in our opinion, to just kind of review fiduciary best practices, because that will always help us be better overseers and stewards of these retirement plans. So on the agenda today, we'll cover regulatory items, including Department of Labor and IRS audits, lost participants, cybersecurity, that's obviously a hot topic, different disclosures related to lifetime income. We'll cover document restatements, and then also just putting some context into, what does the future of retirement plan considerations look like here in America. So we've got lots of stuff to cover today. And with that, I will turn it over to Julie.
Well, thank you all for joining us today. I hope this day finds you well. We all have that sense of dread, I think, if you get that letter in the mail from the IRS or from the Department of Labor. Both of those entities do have the authority to audit retirement plans. So, it could be that you could get a letter from either one or both of those. Hopefully not, but it could happen. The Department of Labor has a charge in their regulations to protect participants in the plan. And the current topics that we are seeing them audit and, investigate are regarding, requiring that when those required disclosures to the participants in the plan, documenting meetings, either meetings with, your investment committee or your plan committee, or those meetings that you're having where you're educating participants, your reporting requirements, such as filing the 5500, depositing, this is another one that we see all the time, depositing participant contributions timely, those deferrals that come out of people's paychecks. And the new kind of on the scene, which we're going to talk about more in the next section, is cybersecurity. That's a real hot topic right now, as Vanessa mentioned. The IRS, or Internal Revenue Service, can also get involved in auditing or reviewing your retirement plan. Typically, when we see them auditing, they're focusing more on keeping your plan in compliance with all the rules and regulations that keep that plan tax qualified. So they're going to be looking at, are you following the terms of your plan document? Are you reviewing your loan and distributions, money going out of the plan? Are you filing the right forms, the right 5500? Do you need to have an audit attached to that 5500? Do you need to file an 8955 or a 5330? Those are some other forms that may come into play with your retirement plan. Are you performing all the required tests that need to be done on your plan each year? And if you failed any of those tests, are you getting those corrected timely? Are you making the right contributions and and allocating those in the proper way? And so making sure those are done each and every year. So as we, if you do think about, getting one of those letters, and, if you get that in the mail, the first thing you want to do is to contact all of your providers that work on your plan. That might be your third-party administrator, your TPA, your record keeper, your trustee, custodian. If you have an investment advisor, if you're one of our clients, contact us, of course, immediately. Keep in mind that an audit can go back as many as 3 to 6 years. So that means you need to have those records on site. If they're physical records, if they're electronic, you want to make sure that you have access to the cloud or wherever you have that stored so that you have those, ready and available. When you get those questions, make sure you're answering exactly what they're asking you, and you're not answering something that they're not asking you. So you want to keep your answers very simple and straight and to the point. You don't want to offer up a bunch of other additional information, if that makes sense. And keep in mind when you're going through this process, if this happens, that they're really auditing your process. They're not necessarily auditing the outcomes of the process. So you want to, what we're going to talk about is really having those good processes in place. And above all, because we're talking about cybersecurity today, make sure that whatever you're providing to either the IRS or to the DOL is always in some kind of a secured format, encrypted, especially if you're providing anything that has to do with participant data, that you want to have that in a very secure format. That would be the last thing you'd want to do, is to be disclosing things about participants in an unsecured way, because that would open you up to a lot more scrutiny at that point in time. So as they say, the best defense is a good offense. So let's talk about some things that will help you really set your plan up for success. You want to have ideally a committee of several individuals that work at your firm that help make those decisions and document those decisions. Have fiduciary training like the one you're attending now. We try to offer these up, as Vanessa said, every year, either in person or virtually. But really, read. If there's any other seminars or sessions that you can go to, anything else you can sign up to online, you want to do that just to keep educated, and make sure that you're documenting when you do those, and you keep a record of that, so you can say that your committee or that you as an individual did that. We want to also, make sure that you're talking or visiting with your service providers, maybe in person, maybe virtually, if that's an option for you, but that you're meeting with them, every year or two, and getting to know them and working with them, and making sure that in the process of meeting with those service providers, that you're benchmarking your fees, and you're looking, what your fees are compared to what other plans of similar size are paying in the marketplace. This is especially important if you are paying those fees from the plan. If you're paying them from company assets, it's not quite as important, although you still want to make sure you're getting, a good value for your services. But if you're paying those from the plan assets, so expensing those to the plan, it's very important that you keep your fees benchmarked every year. And then have a written investment policy statement. And this this IPS, or investment policy statement, doesn't have to guarantee any kind of outcome. It just has to document how you're putting those funds into the plan, and what process you have for evaluating those funds. So again, they're evaluating your process. They're not necessarily evaluating those outcomes that you have. And lastly, if you have, if participants don't make an investment election into your retirement plan, if you have some kind of a default option, you want to make sure that you're looking at that every year too. Make sure, in addition, that you're providing all of your required notices timely to everyone that's required to receive those, all of your participants, and make sure you document when you send them and how you send them, so that if you're ever audited, you can show, and document when you've sent those notices out. Make sure that you know your plan document, the ins and outs, what rules, when people are eligible, when they're not, when they're eligible to take a distribution, when they can participate, what kind of contributions can go in and out of your plan, and make sure that you adjust those as needed over time. And we'll talk about that a little bit too. It may be necessary to change. Make sure you get that wrapped into your document if you decide you want to change something that you're doing. If you do find any errors when you're looking at your plan, always make sure that you correct those. And not only do you correct those, you document how and when you correct those, so that you, again, have that to disclose to anyone who is auditing you, so that you can show, yes, we had an error, we had a problem, here's what we did to fix it, and here's when we fixed it. And always make sure that you've documented when you're testing, any required testing, any required filings like a 5500, you want to document when that was done. And you want to make sure that your bond, you have to have a fidelity bond for your plan, and you want to make sure that that's kept accurate and up to date every year. If it's possible, if your insurance provider will allow you to, see if you can set that up on an automatic increase so that you're always adequately bonded. And a lot of providers are doing that now. And lastly, it might be a good idea to have, consider fiduciary liability insurance. That's not required, but it can help protect your company in the event of a fiduciary breach, if that should ever occur. Now moving on to some specific items that the DOL, or Department of Labor, is really, kind of on fire about at the moment. So the first one is missing participants. And this occurs when somebody, one of your employees has left your employment, they've moved on to, another employer's plan, but they still kept their money in your retirement plan. And so you want to keep an eye out for any kind of returned mail that might come back to you, or bounced emails if you've tried to contact them electronically. And another time, you might see this is one of your providers might reach out to you, and maybe they've sent that person a check. Maybe they did try to take a distribution, or they did, push somebody out of the plan, and that check didn't get cashed. It came back as undeliverable, or that came back into the trust account, and they never cashed it. So those are all warning signs. Any of those things that you might have some issues that you might need to get involved with. So, how do you kind of avoid some of these potential issues? Well, first of all, you want to make sure that you're providing all of your service providers with accurate data. You want to make sure you scrub that data when it comes out of your systems, whether it's payroll or any other kind of HR system that you're using, and that's clean when it goes into the record keeping system, or whatever providers that you're using. Make sure that you always communicate to your employees while they're working with you to keep that information up to date. It would be a good idea to reach out to them at least annually to make sure that their address is on file is correct. If they have any personal email or cell phones, those are things that you would want to keep in your system to have different ways of contacting folks. And make sure that anything you can try to get online for them to do, if they can log into the payroll system, if they can log into their healthcare system, or their retirement plan, make sure that they can see what what those contact points are, and if they see anything wrong, that they let you know. So, but the more we can kind of push that in front of their faces, I think the more up to date it's going to be. And anytime you reach out to them, just try to make sure you're getting that up to date contact information, and make sure that you audit. I would suggest at least maybe annually that information from your service providers that they have on their system, just to make sure it's staying up to date. And in the event that you ever move service providers, maybe you have your plan at this place, and then you decided to move to this other provider over here, they're going to send data from one place to another. So you want to make sure that whatever you're getting from your old system is going into the new system with correct data. So you want to take a look at that as it's going from one system to another to make sure that it stays up to date. Make sure that all the communication that goes out to your participants is easy to understand and not full of complicated jargon. The last thing we want to do is for them to get it and go, I don't understand this, and set it aside. We want them to be able to pick it up, read it, and act on it. So make sure that that's easy to understand. If you're getting those from your provider, make sure you read it and you're understanding what it's saying so that you can answer questions, if those participants reach out to you. You want to make sure too, and if this information is going out to former employees, that it clearly identifies what company this is coming from, so that they know, okay, I used to work there. This is important. I need to pay attention to that. And in some cases, maybe you used to be called something else. Maybe you did, you've been acquired, or you've had a merger, or some kind of a split in your company. You want to make sure in those cases, if you have some employees that may have worked at those other entities, that maybe you list those other company names on there so that they understand why they're getting some kind of notice in the mail. It would be a good idea when you have, you're onboarding a new participant or a new employee, that you really, set them up, get them out there on those systems, get them involved in setting everything up and setting that account up and keeping that up to date. Mention too, this will help the industry as a whole, but mention too, in most cases, they can roll money from a previous employer's plan into your plan. And then, of course, when they leave your employment, then, encourage them as part of that, process when they're leaving. Here's your retirement plan information. Here's how to get that money out of your account. You can roll this money over into your new job. You can roll this over into an IRA, but it helps keep that money moving with that participant, and it gets it out of your plan and keeps your plan in the clear. If you do feel that you have some of those missing participant situations, you want to look at all your resources. You might have information in your payroll system. You might have beneficiary information. You might have emergency contacts. You might have other coworkers, people that still work there that oh, those people were friends together. Find different ways that you can reach out and possibly get those people back on your radar screen. And then there also are some free and paid services out there that you can use if you need to, if those different methods don't work out for you. And in closing this topic, whatever you do with finding these missing participants, you want to make sure that you document when you do and how you do it, so that, again, if you're ever asked by the Department of Labor that, do you have missing participants? What have you done to find them? You will say, okay, here's what we did, and here's what we did on this date, and here's how we tried to reach out with them, in case, you're ever asked. So cover all your bases. Now, moving on, of course, to cybersecurity. This is one of the biggest and most prevalent issues that we have right now. You want to make sure that everyone's data is safe. Chances are, to administer your retirement plan, they're going to need some what they call personally identifiable information, which can include like social security numbers, dates of birth, things that the participants probably wouldn't want to be out there on the internet everywhere. You're going to have to share those with your provider. So because you're going to have to share that, you want to make sure that you're sharing it in an encrypted, very safe way. And you want to make sure that when your providers get that information, that they're also treating it with that same sense of security and keeping their data safe as well. So in 2021, earlier this year, the Department of Labor released some guidance that is supposed to help you as a plan sponsor and us as, service providers to help, really keep it, that data, set us up some standards for keeping our data safe. And they also released some guidance to participants and recommendations to help keep their data safe as well. And even though this guidance just came out in 2021, the Department of Labor has already, during the summer and during the fall, started reaching out and sending information out about, auditing and looking at this information in retirement plans. So this is something that you actually could be getting, a letter in the mail about, because they are really starting to ramp this up. So we want to talk about kind of what was in that and break that down a little bit. So if you have not received any of this information from your service providers, you are going to want to ask them for information on their data security systems, their data security policy. They might have what's called a SOC 2 audit or some other kind of risk assessment audit. You ask them for that, get a copy of it, review it. If you don't have or you can't locate an up-to-date copy of your service agreement, ask for that. Review what is covered in that. Review what protections that you have in that, and make sure that you get those from your service providers. Now, once you've gotten those, what is it that you're supposed to be looking at? Well, you want to look and see what does it say about cybersecurity? What does it say about privacy in the documents they have? Did they have any breaches? Have they already had breaches already? What happened about that? Did you get notified of that, or how will you get notified of that? If that is going to happen. Is the firm audited? If you did and you got that SOC 2 report, you know that they're audited for security. If they got some other kind of risk assessment, they should note that and they should tell you about that and let you know about what their track record is. What is your protection if something like that happens? Do they have insurance? Do they have cyber liability insurance? Do they have errors and omission? All those different kinds of things. You want to know what your service providers are doing and what protections that you have. So be looking for those as you reach through, and read through those documents. Now, as far as service providers, this is where we fall in. This is what we're being held to. We have a to-do list of our own. So we have to have a documented, well-written, laid out cybersecurity policy, and we do, which has clearly defined security roles, responsibilities. We have to have a business continuity or a disaster recovery, you might have heard it called that too, plan in place. We want to, we're going to have our data that's encrypted, any kind of sensitive data is going to be encrypted, have strong technical controls, and, we need to be responsive to those breaches. And so annually, some of the things that we have to do and we do at ML&R, we have to have a risk assessment to, kind of look for those holes in our system, if any, just to see, what we're doing, and we're audited by an outside entity. Get an audit of our security controls, who has access to our systems, how they can get in. And then we want to also look at our stored and our cloud data, just to make sure that that is reviewed and that it's secure. And then annually, we're going to have cybersecurity training, and we just had that not too long ago. So these are some things that your service providers are supposed to be doing, and you're going to want to reach out to them and make sure as you're reading through those documents that they are covering those. Now, as far as participants, this is kind of on the plan sponsor and on your service providers to help make sure they're educated. We want them to get into their accounts. We want them to register their accounts. We want them to set those up. We want them to be in there looking at it. When they're setting that up, we want them to use those strong, unique passwords. We're going to want them to change that periodically. It's not a good idea to set a password up and keep it set up forever and never change it. If your providers have multi-factor authentication available, we highly recommend that you turn that on. Multi-factor authentication is where, they have to have a code come back to a cell phone or to an email, or if it's an app, if your provider uses an app, some kind of biometric security where they're using a thumbprint, something that's an additional form of security to log in. Make sure that they're keeping that personal contact information updated. We want them to make sure that they're, once they're done with an account, they don't work somewhere anymore, they want to get that closed and delete that account. Never use free Wi-Fi. If you're still doing it, please stop. Make sure you're watching out for those phishing attacks. Make sure you know where those emails are coming from. Double check the actual email address, that it's coming from the person it says it is. If you have antivirus software, make sure you're using that. And then, report any cybersecurity threats or identity theft that might happen. Lastly, the last topic that the DOL is going to be honing in on is lifetime income disclosures. And this is a new item that has to be on statements next year during 2022 for most plans. Unfortunately, the way the Department of Labor is requiring that they go out onto the statements is a little bit confusing. And it might require some additional communication or education, either from you as a plan sponsor or from your service providers, to make sure that participants understand exactly what it is that they're seeing on their statement when they get it. So what that's going to look like, what are lifetime income disclosures anyway. They're just showing participants what their benefit is as of right now. So for example, maybe my statement says I have $100 a month as a benefit as of right now for the rest of my lifetime. Well, the way that the disclosures are required to read assumes that I'm already age 67 right now. It doesn't look at what that benefit is actually going to look like once I am age 67. Now, service providers can have multiple levels of income disclosures on their statement. So they could have your benefit now, your benefit, what it will look like at age 67. They can have both of those on the statement, but they have to have the benefit as of now in order for you as a plan sponsor to get protection from anybody ever coming back and having a problem with that disclosure. All of the providers that we're working with are working on those statement redesigns now. And, they're going to be adding in, the required and any additional disclosures. So sometime I would say probably in that first quarter, if you haven't already heard from your service provider, I would reach out to them and ask for what that's going to look like so that you understand it. Ask what communication they're going to be sending. If they can draft communication for you, if it's not going to be easy for that participant to understand, so that you can help your participants when they do have questions, or help ward off those questions when those start rolling out with you. And now I think it is time for our first live polling question. So that's going to be popping up. And that first question we have for you is, which one of those DOL hot button issue worries you the most as a plan sponsor? So if you can take a moment and vote for which one of those that you feel like might worry you or cause you some angst at this point in time. Is it missing participants? Is it cybersecurity? Those lifetime income disclosures? Or you don't have any worries right now, or you're not really worried about those, but the first section we talked about, the audits, that does concern you and that does give you a little bit of heartburn. So we'll give that a couple more seconds. I can see the results coming in. Here are our results. It looks like cybersecurity is the big winner here. Most people are more concerned about the cybersecurity. That does not surprise me at all. And then missing participants next, and followed by the lifetime income disclosures, and then lastly audits. So good deal. All right. So now, okay, so if you haven't already, your plan document likely must be restated before next summer. So you may have already done this, but if you haven't, we have just a few reminders about that process. So every few years, the IRS requires that documents be restated. Most plans are in that cycle right now, incorporating changes that would have come in from the things that Congress did in 2018, 2019, 2020. CARES Act, the Bipartisan Budget Act, the Secure Act. Some of those are required. Some of those are optional. Some of those, you could opt in or out. You want to make sure, that you have documented that for sure. And make sure that you have, if it might be a good time to look at some optional or, changing your plan design. Those are good. And some providers that you work with might let you rope those all, you put those all into one, and then some may make you do those as two separate processes. It really just depends on the service provider. So for the required changes that you might see, the Secure Act is going to be requiring long-time, part-time employees to be allowed to defer or contribute from their paychecks in a couple of years. You have to start tracking that and looking at those numbers now. It's actually going to go into effect in a couple of years, but they may not have to participate in your employer contributions like a match or a profit sharing, but they would have to be allowed to defer. If you do allow for hardships, there's some provisions that had to go into effect, and you could opt in early, or you could opt in, at the last possible date. And then there were some other secure and some other CARES Acts, things that were optional. Make sure that you documented what you did and when you did it, especially if you do change service providers in this time, because when you're going through your document restatement, your service providers are going to need to know which elections you had, which elections were optional, and when you put those into place in your plan. Now, if you've been thinking about possibly enhancing or changing your plan design, again, this might be a good time to look at that. You're not alone. So these are the ones that this was a national survey that was done, across the U.S. In the past 2 years, some of the things that they changed. One, of course, is, increasing the match was the biggest one. And then, if you skip down, number 3 was starting a match. So some people had never even started a match. So getting that matching going in a plan and increasing it was really popular. Increasing and or starting automatic enrollment was also right up there at the top. Roth, of course, has become more and more popular. Most plans we work with have that in there now. If you're not familiar with what automatic enrollment is, this is where you opt everyone in to a certain percentage. Like, let's say you opt everyone in at a rate of 5%. Unless a participant goes in and actually, chooses a different election. Maybe they only want to defer 3%, or maybe they want to do more than 5%, or they don't want to participate at all. But it requires that they actually go in and opt out rather than opt in. And it's a really good way to boost up your participation and get more people into your plan. It's becoming more and more popular. Every time I benchmark a plan, it seems like those numbers are going up and up and up. This is a really good time to put it in your plan too, because they've also added a tax credit, not a huge one, but they have added a tax credit for a few years once you add that automatic enrollment to your plan. So it's a good time to think about that. And then in that same survey, they also looked at, things that plan sponsors were considering either, 2021 and 2022. What were they considering? And again, right up there at the top is increasing their match rate. So they're continuing to increase those match rates. In automatic enrollment popped up, again, up at the top, moved up a little bit higher, adding it and increasing the rate. Maybe they were automatically enrolling people at 3%, and they bumped it up, and now they're going to enroll everybody at 4% or 5%. So they're increasing that rate to get more money and more, those participants to save more for their retirement. And then I kind of want to skip down to number 6, because that's not a concept that most people have heard of, but re-enrollment kind of goes along with that automatic enrollment. And that's where, let's say we're doing a re-enrollment as of January 1st of 2022, and everybody that's not already participating at 5%, we're going to bump all of them up to 5%, not even just the new people, but everybody up to 5%, unless they go in and they make a different election. And that's another a good way to really get those participants re-engaged, make them rethink about their retirement plan, and get that participation rate up, get your deferral rate up, and really make your plan look more competitive too, with comparing those to other folks. So those are some things to think about, just to kind of, see if your plan is competitive, in the marketplace. Those are just some things to think about that the nation is doing. And that brings us to our second polling question. So that'll pop up here in just a second. Our second polling question of the ones that we talked about, which one maybe are you thinking about? Are you thinking about adding automatic enrollment? Maybe adding a match or increasing your match? Maybe that re-enrollment that I just talked about, maybe that does sound interesting to boost your participation rate and increase that. We didn't talk about automatic increase, but that's building in a feature where every year someone is automatically increased, again, unless they opt out of that. Or you just like your plan exactly the way it is and you're not planning any changes right now. So we'll give you a few minutes for those to pop up, and then we'll share those with you. All right. And it looks like most people think their plan is perfect the way it is. So 47% of you said that. Although some people are thinking about that automatic increase. That's great. And increasing their match. And then the rest are split between the automatic enrollment, adding a match, and that re-enrollment concept. All right. Thank you guys. Thanks for participating in that. And with that, I'm going to turn this over to Vanessa, and Vanessa's going to talk a little bit about the future of retirement plans in America.
Yeah, thanks, Julie. Certainly I think there's been a big shift, I think, in terms of people, how they view finances and retirement readiness, just kind of going through COVID and then post coming out of it. And so there certainly has been some renewed focus on retirement plan and readiness, getting Americans prepared. And so that may certainly impact what the future of retirement plans look like in America. Now, there's been lots of studies, and there's various ones out there. Fidelity does one, Vanguard does one, but this was when the Gallup Economy and Personal Finance Survey, that they did this survey last year. And obviously there's a lot of financial concerns with Americans. And, not surprisingly, the top financial concern is just retirement. What does that mean? Is there retirement readiness? And then closely related are other financial concerns around medical costs in the event of illness or an accident, maintaining a standard of living in retirement, and then just medical costs related to normal health care. So obviously this is still a big concern. A majority of Americans don't feel like they have necessarily a perfect plan in place and are ready. Almost 59% of Americans are actually concerned with retirement. And unfortunately, once you dive into those numbers a little bit deeper and look under the hood, is that some of these concerns are, affects minorities disproportionately. So if you actually look at it by race, a lot of them, if you look at Black workers or Latinx workers, they don't feel prepared for retirement because many of them actually lack access to retirement plans. So 52% of Black workers and 68% of Latinx workers lack access to a corporate company-sponsored retirement plan like a 401k. And then when you compare that, only 40% of white workers lack access to a retirement plan. So there's certainly a gap in terms of who has access to a retirement plan. And of course, I think what's nice is what we strive to do is have access available to everyone, because that's really the way that you're going to get folks ready and prepared for retirement. The number one way is to have a workforce plan, because workers are going to be much more likely to save in a plan if they have one available to them rather than doing it on their own. So actually 12 times more likely. And obviously there's a lot of reasons around this. Is one, it's just convenient, and there's that automatic payroll deduction where the money automatically comes out. It gets goes to their retirement account. It's separate from all of their other monies, and it starts building and growing as it's invested. So it's obviously very convenient. Two, it's pretty easy to get enrolled. Usually it's just a form, and there may be some waiting period, but we've seen some of those waiting periods or eligibility criteria shorten, at least as a trend over time. And one thing that Julie touched on was it's becoming increasingly easier as more and more plans start to adopt this idea of automatic enrollment. So again, this is this feature whereas, as soon as someone becomes eligible, that they meet the certain eligibility criteria, then they're automatically going to be enrolled in the plan, and they're going to, they may get automatically enrolled at 3% or 6% or 10%, whatever that automatic enrollment percentage is. Now, keep in mind, folks still have the option to opt out, but they have to make that elective election to opt out of the plan rather than having to make that elective decision to opt in. So again, another way to just make it that much easier, or that that much simpler to just get started in that process. And then third is, of course, the financial incentives. And obviously there's a lot of plans out there that have some sort of match or profit sharing feature. And again, that's free money that's available to participants. And a lot of participants are eager and willing to take advantage of those types of benefits. And what's really interesting is that, you know, once you look at some of these features, for example, plans that have automatic enrollment, when you look at the average participation rate of folks that stay enrolled after getting automatically enrolled into the plan, the participation rate is about 80% on average. And when you dive down and look, there's no meaningful difference between racial lines. So you'll see an 80% participation rates, regardless of it's you know, a Latinx worker, a white worker, you know, what race you're looking at. So that's a good indication that automatic enrollment is a good nudge to get people on that track to start saving and investing for retirement. And you know, obviously this is a big issue and concern both on the state level and on the national level. And on the state level, there are various different programs or proposals that are being looked at, and it varies obviously from state to state. There are some states that have retirement program laws enacted that require or have some sort of plan coverage mandate that if you meet certain criteria, you have to offer a plan. And then other states have some proposal or study underway to try to tackle and address the issue. So it can vary on a state by state level, but there's a lot of efforts as well on the national level to, again, try to combat this issue and help Americans get ready for retirement. So at least on the national level, there's a lot of different things that are getting proposed. Julie, if we can move to the next slide. There we go. A little bit of a delay there. You know, there are various different features that have been talked about or proposed. Now, some of the more important, or I would say popular ones that you've probably heard of or maybe familiar with is, again, the automatic enrollment, where it's automatically going to enroll someone to defer at a certain percentage, although they still have the ability to opt out. They're not required. But again, it's that perfect nudge to at least eliminate that extra step of them having to actually enroll. There's some other things that have been proposed too, things such as higher limits. So, you know, right now for someone under 50, they can defer $19,500, talking about increasing those limits or increasing the limits for those over 50. There's also incentives for sponsors, so plan sponsors to start a plan and make one available to their employees. There's some tax credits that have been rolled out in the past couple of years, but then there's been proposals to expand upon those, make those a little bit more meaty and meaningful to, again, incentivize sponsors to make this available to their employees. And then other things like pushing RMDs. One that's been talked about is pushing it to age 75. RMDs are those ages that the age where you have to start taking annual distributions. So it actually did get pushed back a couple of years ago through the Secure Act to age 72. Now it's been talked about pushing it back even more to age 75. And then some other things that have been talked about as well, and this kind of is it hits two major issues that are affecting American workers. It's saving for retirement, but also mounting student loans. So there are some proposals to talk about allowing matches, that employers can put a match or make a match to student loan payments if their employees make a payment. And obviously it all is somewhat connected. If employees have mounting student debt, that may prohibit them from saving and putting money away for retirement. So you have to kind of help address one issue in order to allow folks to then focus and tackle the retirement issue. And obviously some of these combined changes, I think, are projected to bring in a large swath of Americans who don't have access to a retirement plan and start saving. So, you know, this could really impact tens of millions of Americans who may not have access or who may not be contributing to a retirement plan as is. So again, there's a lot of, I think, really meaty proposals out there that can really have a significant impact. And it's going to address folks from various different income levels and different by different races as well. So again, trying to target those that make under $100,000 a year. These are the new savers that may not have either had access to a plan or really didn't have felt like they had the financial safety net to be able to start putting money away for the future. And hopefully, again, we'll bring in folks that have been largely underserved in the retirement space previously. But, 401ks and saving for retirement through a retirement plan at work, that's just the perfect and initial, I would say, entry point for more comprehensive financial wellness and preparedness, because 401k and retirement, it's one piece of the puzzle. But it can still bring opportunity and I think responsibility for plan sponsors, again, to bring focus on the bigger picture. So I think as a result, more plan sponsors and employers, they're thinking beyond just retirement and thinking about a more comprehensive financial wellness. Because there's lots of studies that show that financial stress is often linked with poor or suboptimal performance at work by employees. So, if you really think about it, how can your employees focus on work if they're even just struggling to pay the bills or manage debt? And second, I think, particularly more recently we're in a very tight labor market. So this is a great opportunity too for plan sponsors, if they're able to tout this more comprehensive financial education and training, it just helps them, gives them an edge up on being able to attract and retain employees and talent. So, I think there's a lot of education beyond just saving for retirement. It can be how to manage and pay down debt, things like credit card debt or student loans. The importance of emergency savings. That's really the first line of defense. So it's really important for everyone to have that emergency reserve so that a participant doesn't have to go start racking up credit card debt or have to start taking loans out or hardship distributions from their retirement plans. And then other things more comprehensive, like, okay, if you've gotten enrolled and are on a plan and on a track to save for retirement, and then beyond that, employees or participants may start thinking about, how do I start saving and planning for college if I want to help pay those expenses and cover those expenses for my dependents, or general estate planning. And so there's a lot of different opportunities there. And I think this is where you can really lean on your service providers to help you. For example, that's something that we spend a lot of our time when we're working with our retirement plan clients, is to help bring a more catered education approach that focuses on the participants. And it's really, when we think about it, when we set out to work with corporate retirement plans over 15 years ago, what we set out to do was try to bring the same high touch and planning focus that we provide our individual clients to the retirement plan space, to these retirement participants. And so many 401k participants, they may not be able to afford or have the need yet to hire a personal advisor, but yet they could still greatly benefit from professional advice and guidance. And so what we do with our clients is we try to develop kind of an annual education plan with the plan sponsor. What are some topics that we want to cover over the course of the year or several years, and largely going to be based on employee needs and demographics. So we want to put together and make available group education that's going to be relevant to their employees. So group-based education is very important, and making sure that we cover, again, various different types of employees that they may have. So if we have a client that has a lot of Spanish speakers that are eligible to participate, we don't want to just neglect or ignore them. We want to try to cater that education to those Spanish speakers, partner with our service providers to make that information and education available to them as well. So group education is going to be a really important starting point. And then also having one-on-one meetings or one-on-one opportunities for participants to set up a time with an advisor to have professional guidance. They can talk about their own personal situation. If they have questions related to the plan or investment options, they have a dedicated team that they can talk to. They don't necessarily just have to rely on some 1-800 number where they may or may not get any meaningful advice or information. And then beyond that, you want to make sure that you're giving relevant resources so we can develop targeted communications, again, through articles or newsletters, and just to build that familiarity so that they have a team that they know that they can go to, whether it's ML&R or if you're working with a different service provider, that they know they have a go-to resource rather than them coming to you, whether you're in finance or HR or a business owner trying to field participant questions. Okay. And with that, I think we are now on to our last polling question. Okay. And question 3, what future plan regulation would you like to see enacted? We have increased catch-up limits near retirement, increasing the required minimum distribution age, required automatic enrollment, student loan matching, I don't want any of them enacted, or I have something else that they need to change. All right, a majority would like to see increased catch-up limits near retirement. Well, we certainly, I know, covered a lot today. Julie and I, we certainly want to continue conversations. So if you guys have specific questions, we still have a few minutes if you do want to submit a Q&A or a question through the Q&A chat function. Or, of course, you can always call us, email us. We're happy to talk through any of these question or issues. Maybe it prompted some ideas that you just want to talk through and bounce some ideas off of. So we'd certainly love to hear from any of you if there's any ideas to, I think, be more prepared from a fiduciary perspective and also just make the experience better for your plan participants.
We also did put in the chat that there's a evaluation for CPE. If you want to click on that before you exit, you should see that link in the chat. Everybody, and fill that out for us, please. And of course, feel free to contact us. Our contact information's up there if you don't already have it. If you're not one of our clients and you do have some questions or we're not somebody you normally converse with, please feel free to reach out. That's what we're here for. So we thank you for joining us and thank you for logging in today. Hopefully you learned at least 1 or 2 new things or, brought some new things to mind, and stay in touch. Again, if you have questions, reach out, and have a great rest of your Tuesday. Bye-bye.
Thanks all. Bye-bye.
Bye.